All right, a quick disclaimer before we get started. The purpose of this conversation is for informational and educational purposes only and should not be construed as a recommendation to purchase or sell any security. MicroCapClub is not a registered investment advisor. MicroCapClub, its partners, members, subscribers, affiliates, guests may or may not hold positions in one or more of the securities mentioned on this program and may trade in such securities at any time. Do your own due diligence and seek counsel from a registered investment advisor before trading any security. As a reminder, if you're listening to this live, you can ask questions by clicking the Q&A button at the bottom of the Zoom screen, entering them there, and we'll try to get to them during or after the conversation. I want to thank everyone for tuning into this conversation with Harris Perlman. Harris has been a full-time investor, I think back to late 2017, early 2018.
Yeah, 2018.
And I think you've been a member since 2014, so I think we're hitting your 10-year anniversary, which is pretty cool. Thanks for joining us today.
Thanks for having me, and thanks for having the club. I mean, I was very happy to be able to join the club back then. So yeah, it's been a good run.
Yeah, time flies.
Yeah.
I've been looking forward to this interview because I think, your kind of path sort of resembles mine, where you became a full-time private investor almost exactly the same age as I did. I think you're 10 years younger. And I just think there's some interesting conversations we can have on that around actively managing a portfolio around your spending and lifestyle. And we'll get into that a little bit later. But before we do, what do you think of the current environment we're in right now?
Yeah, it's pretty wild, isn't it? Um, what can I say? I mean, I've only been investing, like my first real exposure to investing was probably around the time of the financial crisis and the Great Recession. So I was kind of like born into an environment where things were very like sober and depressed, and everyone was thinking, okay, that was wild. Not going to do that again. Like, the housing bubble and all of that stuff. And then kind of like my progression so far as an investor has coincided with like the reinflating of everything. And I guess it's taken, like 15 years, but it feels like maybe now we're like fully inflated again in some way. I don't really know the way that this is going to play out, but I have like my suspicions that, we've kind of gone from like peak to peak, and things are probably going to be bad from here.
How have you seen it kind of play out in the portfolio? Are you kind of selling things? Are you having issues finding new things? How does that kind of manifest itself, like the current environment?
Like definitely having issues finding new things. I kind of have a mentality that because I am still a small investor, small portfolio, relatively speaking, there's always something to find that's cheap. Like there's something out there. So I generally think that I can be fully invested if I'm looking for, new opportunities regularly and a lot of small opportunities. So I am basically still fully invested. But yeah, I'm not as interested in doing research right now because just not a lot of interesting stuff out there. So if I've got a portfolio that I'm okay with and I'm trying to avoid stuff that I think is going to do poorly in a, market blow up. But yeah, just trying to stick to the knitting, find stuff that's cheap and just ride it out whenever it plays out.
Yeah, it is difficult. I have a watch list of maybe 30 or 40 companies, and some of them are more liquid than others. And I
Mm.
know that there's a few companies on there that if we just had three down days in a row, they'd be down 25%, and so it's hard to get too excited or anxious to take the offer, in any security right now because of that.
Yeah. I've got a couple companies where if someone crossed the bid-ask spread, probably be down 25%.
You made a you made a tweet, I think it was yesterday or the day before, which I thought was quite good. And I think I'm paraphrasing a little bit, but you said lots of people learn to lean into their strengths and can do very well. A venture capitalist is a forest guy and a quant is a tree guy. Buffett is so impressive because he's a master in both areas. The real danger lies in being mediocre at both. And I'd like you to maybe unpack that a little bit, that thought. And as you reflect on that in your own abilities, how do you protect yourself from being mediocre?
Yeah. Uh, no, look, it's tough. I mean, investing is a lot of a game of experience, learning and experience. So, I mean, you've got to learn accounting, I think, to be, certainly if you want to be, as I called it, like a tree guy, if you want to be able to understand how a financial statement works, how, return on equity, valuation, these kind of metrics should be calculated and should be thought about, you've got to really do your work and learn this stuff. And unfortunately, they don't teach it in a lot of undergrad schools. I mean, I studied like a little bit of economics in undergrad, but they didn't get into accounting. So you kind of have to learn it yourself. Um, the business stuff, I mean, learning how businesses work, like what I said is like a forest analyst, like a venture capitalist kind of person. I mean, that's really more like you have to just look at history of a lot of different companies, understanding how industries play out, how companies play out. It's really getting into like how moats work. You can read a lot. I mean, there's stuff out there about understanding competitive advantages, but I think a lot of that comes from just experience, like doing the reps, if necessary with your own money, but ideally by watching what's happened in the past with other people's investments. I think I've said before, like you can go on Value Investors Club and read a lot of old stock pitches and just see how things have played out. Connor Haley did a great thing when he put together this big case study presentation. I think he had like some interns do it for a summer several years ago and looked at like the top performing small cap companies around the world. And you can just see like what were the setups. And a lot of that is a lot about the quality of the businesses. It's not all about the quality of businesses, but understanding business quality really takes a lot of analysis of case studies and just experience.
Yeah, and I think one of the other takeaways there was you need, earnings per share growth and multiple expansion, and we've seen the latter quite a bit, I think, in the last few years in the markets, in general, which makes it
Yeah.
hard because you need that double lever, to get those big wins over a long period of time.
Yeah, generally, yes. I mean, long term, you're really going to be tracking the earnings per share more. But I think realistically, if long term is like 50 years, then yeah, in a 10-year period, the expansion of the multiple could still be very, very important.
You got into investing, or at least intrigued with the stock market, I believe, really early on. And I think I remember hearing that it was kind of from your father,
Yeah,
who was kind of into technical analysis and charts.
yeah,
Became obsessed with that. Is
yeah.
that kind of when everything started for you?
It's sort of how everything started for me. My dad still pings me and says like, "Hey, look at this little company. I want to trade this thing." Um, and he just does his own thing. Like he'll do some of his own, trading. I manage some of my parents' retirement money, but he'll trade a lot of the same kind of microcap companies that I might have in my universe, investable universe, but they're generally not the kind of companies that I would personally invest in. And so he'll ping me and I'll tell him like, okay, this one's total toxic waste. Don't touch this one, but I'll kind of give it sort of like, okay, this is a real company. If you want to just trade this one using technical analysis, that's probably, okay. But that was my first exposure when I was like, I don't know, probably 12, 13 years old kind of thing. And he gave me a couple of these like trading books where you could draw all the different lines on the charts. And I just wasn't into that at all. And so, unfortunately, my first exposure to the investing world was like something that didn't make any sense to me and still doesn't really make sense to me. But it did expose me to the fact that, like, oh, there are these things that you can invest in, there's stocks. And that was something that I came back to when I started being interested in business, sort of as like later in my teenage years. And that's when I started actually trying to figure out like how I could understand how this whole thing works in a way that makes sense.
So I think you then, when you went to college, you went to work for a hedge fund. Was that correct? Right.
After college, I spent a little over a year at BlackRock. So
Okay.
that was like more of like a mutual fund team. And then after that, I moved to a hedge fund for, I mean, that's basically where I worked for like my career. I was there for like a little over 4 years.
Did you pick up any interesting skill sets during those few years, or
Yeah, I mean, the fund I worked for, I think those guys were incredibly smart people. And so I think a lot of the investing world is sort of like apprenticeship based. Like you work for some place, somebody who is going to teach you the ropes, and you're going to, get your education there. Because I mean, realistically speaking, I have not been to business school, but I have met plenty of people who have gone to business school and are then trying to make it as investment analyst. And you just don't learn what you need to know at business school. You learn it kind of as an apprenticeship. So, yeah, like I was working for this fund called QVT, and those guys are incredibly smart. Actually, well, I never actually met Vivek Ramaswamy, but he was like one of the, I mean, that was where he worked. That he was a PM in the biotech portfolio. We didn't really overlap, but like in terms of the quality of the people there, there were some insanely smart people there. And I worked for a great guy directly under a PM who was a great guy. We still keep in touch. And I basically just learned from doing, and most of like anything, certainly anything I know how to do in Excel, I learned there. But just in general, like it really just sharpens your analytical ability.
do you think do you think going and getting a CFA is important?
Well, actually, one of the things you learn if you do the CFA exams is you'll learn that you cannot get a CFA. You have to be a CFA charter holder. So, yes, I think being a CFA charter holder was a good thing. I think there's a lot of rigor in those exams, and certainly a lot of stuff that it might get glossed over when you're learning the experience-based, apprenticeship-based path. So like you're not going to use a lot of it necessarily. Like sometimes it'll come up in weird ways. I literally had to just explain to a friend of mine some of the intricacies of pension accounting as I recall them, um, which is something that you learn in the CFA. But yeah, I think if you're looking to do some sort of like continuing education, and if you have the time for it, which is really because it's a real time commitment, it's a good idea.
What was it? Do you remember like the first big win that you had that you feel like you did extra work into that ended up, really manifesting itself in the portfolio? Do you remember that one that gave you confidence?
I mean, there were a couple that were pretty early. I don't know, two come to mind. It's funny because one of them actually had to do with pension accounting. Although it was before I did the CFA exams. There was a company called Magnatech, ticker symbol is MAG, I believe. That was an industrial company that had like a big underfunded pension, but the pension was not really going to sink the company based on how pensions work. And also was probably an overstated liability because the discount rate was probably unrealistically low at that point, which was like, during the 0% interest rate environment. Um, and I found this thing like I think when I was in college, and it traded at like 3 times earnings if you kind of like adjusted for all the weird pension math. And it eventually got taken out. I think it was by a company, Columbus McKinnon. And I was like 5 times, multiple on that, like made 5 times the money. There was a tiny company that I made some good money in, but ended up being very frustrating for like people who've followed it long term, which is called Coda Octopus. And that thing is still around. Now it's on the NASDAQ. But when I first bought it, I think it was like, it was OTC, probably like a sub $10 million market cap. And it was making like $5 million of profit, which is just kind of like wild. Um, and I did research on both those businesses. I didn't do as much like fundamental business research in Magnatech because it was really just like, understanding the accounting better than people. That was like a $30 million market cap company. So really, these are tiny micro cap, nano cap things. For Coda Octopus, and I think I mentioned on like one of my other podcasts I did, I actually like went to this like presentation day that they were hosting down in like, St. Petersburg, outside of Tampa, Florida. And I was the only investor who showed up because it wasn't an event for investors, because I just kind of asked them if I could come to this day that they were going to like present their technology to customers. And it was weird. Like I thought it was fun. At the end of the day, it wasn't really like the thing that moved the needle in the analysis of like whether I knew that the technology was good and customers liked it. And there was all sorts of other crazy stuff that went on, and you could probably go back and look at the history of that. But yeah, I mean, finding a couple of things at like 2 or 3 times earnings, and making some decent money on them, was definitely confidence building to do this.
Well, and it's funny with Coda Octopus too. It's almost the perfect example of a microcap because there's very few new ideas in microcap. It's simply an old idea with a new management team or strategy. And I remember looking at Coda Octopus 12 months ago. Um,
Yeah.
it
I think
that one, oddly enough, I think it has a female CEO that owns 20% of the company, which is also rare that you find in a microcap, which is interesting.
Yeah, I think like I was never able to get in touch with the head of the management team there. So I think maybe the challenge with that one is that there hasn't been change in the management team, because I've heard from other people in the space that these aren't necessarily the best managers of the business, and unfortunately, they've also hoarded cash over the past decade plus. So you know, I remember asking the CEO of Kraken Robotics back when I met with him several years ago about Coda Octopus, and I asked him, those guys have such a low valuation. What do you think of them? And he basically just agreed with me, but he said, like, we've got better technology and a better management team. And to be fair, Kraken's done a lot better over the past 10 years than Coda has, I think, although I made some money on it early on. So
Mhm.
one thing you've said a lot, which I agree, and I've come to agree more and more over time, is that especially for these very small companies, you have to know that the management team is a good team, and you have to be able to, bet on the team to some extent, because none of these companies are going to be that amazing as an existing business that they can survive or thrive without a good management.
Do you even today, do you talk to the management teams of your larger positions?
Oh, for sure. Yeah.
Okay. So that's a part of your strategy then today as well.
Yeah.
When when you were building your capital, call it in 2014, 2015, 2016, when did becoming a full-time private investor sort of get on your radar? Was it
Um, Yeah. Well, I actually had like a plan. I mean, I actually did plan it out. I think I probably started planning it out around that time, around probably 2014, 2015. Um, I recently posted on Twitter, because one of my things is that I'm interested in personal finance. And I mentioned that there was like one specific site I really liked, which was the site called MrMoneyMustache.com, which was about like personal finance and early retirement. And I forgot the guy's name who did most of the writing on the blog, but it was just very, refreshing and inspiring to think about the real math behind financial independence, what people call early retirement. Um, and so once I kind of got plugged into some of that, and that was really like, now it has a name. It's like the FIRE movement, financial independence slash retire early. And I was learning about that when it was really pretty new. Like this was sort of all just being like um, generated on the internet at the time. And so once I kind of learned about that, like the idea of, oh, well, if you can save like, 25 years of your expenses, equivalent to like the 4% withdrawal rate, you might be able to just live off of that. And obviously, I had my own opinions about like being able to generate above market returns, because, I'm not going to just put my money in an ETF. And that can change your analysis around things. But having a target, being able to think like, oh, I could actually maybe just do this if I can save up enough money, then it just kind of gets you on a path, and then you're just trying to, reach that destination.
did did your strategy change at all once you became a full-time private investor? Like as it relates to position sizing or the amount of cash you held or all of those things?
Yeah, well, the fact is, it was really hard to trade my portfolio when I was working at a hedge fund. Um, I think it's pretty standard that most funds just like will not allow their analysts to just trade their own portfolios. Or if they do, there'll be a lot of compliance restrictions. So that was actually one extra reason why I was interested in leaving my full-time job to do this full time because I just couldn't compound my capital the way that I wanted to because I couldn't really trade when I was working. So um, as far as how things changed, like when I first started as a full-time investor, I think I kind of fell into a little trap. Fortunately, it was pretty short-lived, but I started thinking in terms of like I should be investing in companies that are generating enough earnings such that like my effective like look through income is enough to cover my expenses and then I can like actually have that kind of cushion. So like if I knew that my, expenditures were whatever, and like I bought, 100 shares of a company that makes, $2 a share of earnings, then I would count that as like $200 a year of income that's going towards my like expenses. And to be honest, that was a terrible idea, which was the reason is because I basically was falling into a trap of buying lower quality things that weren't necessarily as cheap just because it could like satisfy this really silly criteria I was creating for myself. And so when I kind of put that back aside and said, okay, I'm just going to buy stuff that's undervalued, regardless of what the current earnings is, that's when it allows you to go out and buy stuff that's like, for example, a higher growth company that might not be generating a lot of current earnings or might be at a high multiple, but it's growing so quickly that you can make a lot of money on it. So changing to a just a total return mindset, which is really where I should have been the whole time, definitely did help me.
What was the kind of looking back, what was your highest anxiety or stress moment, since that decision to be a full-time investor?
Oh, that's tough. Um, it was, I think I recall, I'd have to look up the chart. Um, I think it was early 2019. Um, and I had, I made some money in 2018, my first year, and then I had built up a few positions. One of my big positions was Expel at that point, and I had a couple others that were pretty sizable. I'm generally pretty concentrated, and I think Expel reported bad quarterly numbers, and it was like the last time for like 5 years that they reported bad quarterly numbers. Um, and the stock was down like 20% in a day. And it was on the heels of a couple of my other investments, like having some lousy earnings. And I was just so bummed. And I went out to lunch or something with this guy I used to work with, and he had like taken a new job, and we were talking about, life and stuff. And I was just sitting there thinking, like, oh, I'm down so much today. I don't even know if this is going to really work. Like, how is this not going well? And I was pretty low. And when you get like that, it sucks. And the only thing that can really, well, for me, the only thing that really works for me is to just remind myself. Sometimes it's by going back and looking at like my own notes and case studies on historical stuff, just to, stay the course and, stick to the process that to work. So, fortunately, that was sort of the low point for me. And by the time 2020 came around, I had already, made a good deal of money since then. So even the March 2020 crash wasn't really like existential for me. Um,
Mhm.
and since then, it was really, after the lows of 2020, we all know what happened. So,
Yeah, I remember, I think it was probably a similar time. I think it was like a year or two after I became a full-time investor. I had kind of one of those, situations like you where I had one or two companies. Of course, your largest positions are down 20%, then you start questioning yourself, your abilities. And I think that's the biggest thing too. It's less because I was very cost conscious with my expenses. I had it down to where, I could live on $2,000 a month, and that's not a big deal. But kind of the emotional load of seeing the portfolio go down and draw down at the same time, it's like 10 times the load when you're
Yeah.
emotionally. I remember going through that a few times. So I appreciate you sharing that.
Yeah.
What, how would you best describe yourself as an investor today? You probably don't like to put yourself into a box, but what type of
Mhm.
investor are you today? What initially attracts you to a new idea?
Um, so big picture, I believe in profitable businesses. That's one of the key things that I really care about. I don't like speculating on, early stage businesses. I like things with established business models that are generating profit. Uh, I really, really need to get into the weeds generally to understand a company's business model, to understand its competitive advantages and the industry structure. So I spend a lot of time on that generally. Like I really want to know like who are the competitors, what are their levels of, differentiation, how do they compete in this market? Um, and it tends to also mean that I'm pretty, rigorous on I guess doesn't necessarily lead to that conclusion, but I'm also very rigorous, I think, on valuation. Like I just really don't like buying anything above like a certain level of multiple of earnings. Like I'm more flexible than I was in the past. I think I've said as much. Like I think I could go up to like 30 times or 40 times earnings for like a truly extraordinary business with incredible growth. But I just also try to remember that the world is very unpredictable and uncertain. And just because you have a thesis that like this is the way that everything is going to play out, this is like the course over the next 5 years, there's so much that we can't know. There's so much uncertainty and unknowable unknowables that to be disciplined on valuation in terms of like what multiples you'll pay for a business is really just to protect yourself from getting overextended and thinking that you can predict more than you actually can. So I don't know what kind of investor that makes me necessarily. I think I'm usually quite, rigorous and disciplined, but I try to also be flexible.
Are there any, I think you mentioned before that you are typically in 5 to 7 kind of core positions that make up a bulk of the portfolio. Uh,
Hmm.
and that's sort of how I am too. Are there any similarities between those large positions in the portfolio today?
Yeah, well, right now, I think the core of my portfolio is almost all stuff with a lot of like tangible asset value. So, um, I've talked about my biggest position is this company, Seneca Foods. I've got a couple little banks, stuff that's really cheap. Some like hardline businesses like a lumber distributor. I have a few like little software positions, just a few little things that, I think are at like low multiples and have good growth. But um, the bulk of the portfolio is in the form of stuff that's like under the value of the hard assets, real estate, net current assets, that kind of stuff.
Do you feel like you have any, do you feel like you're biased in any way when it comes to the new ideas you're looking at, where you kind of gravitate more towards situations that obviously are cheap and you like to be the first person or at least part of the first group of people that has this variant view on the thesis, looking out 3 years. Is that a
Hmm.
fair assessment of how you like the setup at least?
I do like to be one of the first people to understand something, but it's really because being one of the first people to understand something generally coincides with that thing being attractively priced. I mean, um, hypothetically, if I get ideas from a couple of my friends who already own a stock, like that's fine with me. I guess I'd still do kind of have a preference that like I figured it all out first. But having a couple other people who I know are smart to do the research also does give me a little bit more confidence that I haven't missed something in my analysis. Like it's incredibly nerve-wracking if you are like the first person to have a thesis, have this like variant view about a company, and you just don't know if you're totally off because you probably haven't run it by like a whole bunch of people. You haven't put it out there in the world to know, oh, well, naturally you should have been asking this question, which anyone who, you know, knows the widget industry as intimately as this other person does would know to ask, right? Like, uh, so it's a trade-off. But yeah, generally like by the time you're hearing about an idea from like all of your friends, it's probably just something to keep in the back of your mind. Like,
Yeah,
yeah.
I'm the same way. I mean, I think what's interesting too is with, I think, really good stock pickers. I mean, they tend to be very independent, but they also have a core group or handful of other stock pickers they trust that they bounce ideas off with, and I
Hmm.
think, and I'd be curious, like, how important kind of your close network of folks, what that means to you when it comes to idea generation, and also just being a sounding board.
Yeah. It's always tricky. I mean, the investment friend, like the friendship game in investing is very tricky. Because you try not to step on each other's toes too much. Like you don't want to be sharing your ideas with a bunch of people who are going to basically front run you before you have an opportunity to build a position. So you also kind of want to, share your ideas closely when you're still doing your initial research, if you do feel the need to bounce your ideas off of other people. Um, but yeah, I do very much value like a small group of my friends who I think are very smart. And some of the best friends you can have are people who either have too much money to care about your tiny idea and therefore won't front run you into it, or they have so little money that they won't be able to move the stock too much if they do front run you into it. So there is this like very complex interplay of how do you decide who to share an idea with if you want early stage feedback.
Well, I think too, it's pretty close-minded, and that's the way I was, at least for a short period of time, was like I need to be the person that finds it first, does all the work, don't really listen to other people, and I think we're also different in our strategies and what we look for. Even a lot of the people I respect, their flavor of investing is completely different than mine, but they know what I look for, and they're sharing those ideas with me, even though they'll never buy it, and
Hmm.
vice versa. So it's a lot of that kind of reciprocation, that goes around too. Not everybody sees the world exactly like you do, you know.
Yeah. One challenge is that when you have complicated ideas or when you have stuff that like requires real analysis, um, just like pinging somebody for feedback to get like, their half an hour of research kind of opinion on the idea just ne won't necessarily help you too much. You really kind of want somebody who's going to go nuts and is just going to spend a week analyzing something and will tell you what they think after that. And it's hard to find those people. And if you do find those people, you should sort of expect that if they like the idea, they're going to want to buy some. So that's why I think it kind of gets into this sensitive topic of, how to
mhm.
not step on each other's toes too much.
When you look at your holdings today and the past 10 years, I mean, what would you say the average holding period is for an investment that you've had? And
Oh man.
I know you're not a buy and hold forever type of person. You're going to buy as hold as the thesis plays out and the stock's cheap enough compared to where you think it's going.
Hmm.
But when you reflect back on the portfolio, what does that turnover look like, and what would you say the average holding period is?
I think for my big positions, it tends to be fairly long relative to my smaller positions, usually just because the smaller positions are just not such good ideas. So if I find something that's good, it'll usually take a little while to work and I'll play out and I'll just own it for a while. Um, I think for most of my big positions, I've tended to hold them for, at least a couple years, if not longer. Um, some of them kind of play out because of things outside of your control. I mean, when I wrote up Collector's Universe, which was early 2020, I was thinking like, hey, I'll own this one for years, and it can be a core part of the portfolio for a long time. And then, I was stressing out. Like almost a year later, I was stressing out because the company was being acquired, and I was gonna like some of the stock that I owned was like a week away from going short term to long term capital gains. And I'm looking at this thing, and I'm like, man, like if this deal closes in like a week versus in 2 weeks or whatever it would have been, like I'm gonna have to. Like it was I was running the numbers like how much extra tax I was gonna pay just because like they were forcing me to sell my stock on a certain date. So sometimes you'll be taken out before you want. But generally, yeah, if you get something right, it can still take at least a couple years for people to really figure it out.
How do you balance those two types of positions between the ones that you're highly convicted in? You can take a decent position size, they're the 10% kind of positions in the portfolio or more, versus the wait and sees, that are interesting. They kind of have 7 out of the 10 elements you look for, and they're either going to evolve in a good way or a bad way. How do you balance that? And do you ever reflect on them? Is it worthwhile for the wait and sees at all? How do
Yeah.
you think about that?
I think the big takeaway is I should just not touch the wait and sees. I mean, there are lots of companies out there that I don't have a catalyst in mind for them. So I don't know when they could possibly re-rate. But that's not necessarily to call them a wait and see kind of idea. It's just that they're, like everything, there's uncertainty. So I think if something's cheap enough that it's a good investment, with or without a catalyst, it might be a good investment. But yeah, I think I should learn to just keep almost everything that I'm questionable on just on the watch list, just not even buy any of it. I mean, people say like, "Oh, buy a little bit, buy 1%, you'll keep it on your mind, then you'll think about it." But like then I think about it when it goes down and I think, why did I buy 1%? Why did I put 1% of my portfolio into this stupid thing? Like I should have just put 0% into it and just had the discipline to keep an eye on it.
I think a lot of times the small positions are just kind of like we all like to be doing something. It's almost like
Yeah.
the price we pay for our impatience to wait for something that's great. It's just and you're gonna have this 5 or 10% drag that's in the portfolio from these things that are wait and sees just because you can't sit there and not do something, and you're trying to control that. But it's a tough balance. I was always in the sort of, I'm either 110% convicted in this, and it's going to be a real position, or it's not team. And I've kind of evolved into, I'm okay holding a few of these other positions, but the smaller positions, quite honestly, it might be with you too, or usually it's because they're so illiquid. It's not like I can buy a full position anyway, at the price I
Yes.
want, and if it does evolve in a better way, I'm fine paying 50% higher if it warrants it, the business progress. So you're kind of forced to have that smaller position just because of the illiquidity profile of the company.
Yes. I mean, those can be great. If you can find something that's an amazing deal, but you can only put 1 or 2% of your money into it, I think absolutely I'll go for that. Um, but yeah, those are also tough just because you're kind of always itching to push the price up to buy some more of it. And you have to remember that it's not going to be a good investment if you push the price up so much. So, it might just be the case that you have to sit on a 1% or 2% position weight on something illiquid and just hope eventually you can get a bit more.
Yeah, that's true. I tweeted out, I forget, a couple of months ago, and there's probably 3 people, including yourself, that would laugh at it. But it was basically a meme of the same guy slapping, high-fiving himself. And I just put above it, like, I helped it get to a new 52-week high, buying it myself, basically.
Yeah, I've learned that that's not usually a good thing.
Yeah, exactly. Do you have any rules that you set up for yourself, kind of position sizing wise? I mean, you talked about Seneca, it's probably, I don't know if that's your largest position, but how do you think about position sizing with some of those winners that you have in the portfolio?
I'll get pretty big and stuff that is a real winner that I really like. I think the real question is just, can I sleep at night? I think if I can sleep at night with a position, it means that on some perhaps subconscious level, I truly understand, or I truly believe I understand the risk profile of a certain investment, and it makes me comfortable enough with, whatever the numerical position size is. Um, I remember when Expel got to like 100, and I had, I don't know, probably 50% or 50% of my portfolio in it still, or maybe not quite that much when it was at 100, but it's probably darn close to 40%. And at that point, I was sweating, and 100 was, in my opinion, was too high. So I took a bunch off the table, and then I could sleep at night again, and I eventually, exited the rest of the position. Um, but it really depends. I mean, there are some positions that I've had where I'm stressed out if it was a 10% position, like there's some stuff that I don't want. I'm stressing out if it's a 5% position. And that's really because you have an idea like, this is a risky thing, or maybe it's just not cheap anymore or whatever. And I learned to trust those instincts better because the instincts are, I think my instincts are coming from deep recesses of my analytical brain that are telling me, regardless of whether I can communicate it openly to myself, like this is good or this is bad.
What what does your typical day look like? I know you're reading novels right now, but do you have a typical day that you get up and do? I mean, what does it look like? A lot of people want to know kind of what a full-time private investor, their day, their weeks, if they allocate a certain percentage of time to this or that, how do you
Yeah.
what do you do?
Yeah, I've been trying to spend a little less time on the computer recently. I get up, I get up kind of early, earlier than I used to. I probably get up like earlier than 7 every day, and check stuff on the markets and my portfolio and Twitter sometimes, probably most of the time. And then I'll usually just like, get some food, maybe like, do some errands, maybe go to the gym. Usually by that time my girlfriend's awake, so we'll hang out. And at some point we'll get lunch. I'll make myself lunch or something. And I don't know. I mean, it sounds kind of like silly. I mean, when things are busy, I'll be at my computer all day. And when things are not busy, I'll just kind of hang around and, go for a walk or go do something or go read a book. Um, what does anyone do when they're not working? I don't know.
Yeah, no, I figured that's it's a little bit of how I was too. I mean, to some regards, like you try to find productive distractions too from the market because especially when you're concentrated, it's easy to overthink kind of your own positions and overanalyze little details that don't matter, as well because that's you have all day to look at things. So I think
Mhm.
it's trying to find that balance of where you can be productive. Um, and also, it's like the reason you're a full-time investor is so you can enjoy life, not that
Yes.
you're just staring at the computer from 6 a.m. to 11 p.m. every night. And at least
Yeah.
I don't have an employer, it's like, well, that's not really living either, so
Yes. Yes. It's
uh,
hard to remember sometimes, but it's important to remember that.
do you find it fulfilling being a, full-time investor in this?
Well, I don't know if it's fulfilling in like a spiritual sense.
Yeah. You can take that question as open-ended as you want. So
Um, I like what I do. I mean, I love playing games and I love competing. Um, so I think those things just naturally pull me towards investing. And I love not having to, go to the office and have a boss. So in that sense, like I'm very happy with what I do. Like, don't get me wrong, I'm very, very happy with like my career as it is, if it's a career. Um, and I do think it's important to still, remember that there are other elements of life that you should be spending time to develop yourself. And yeah, like that's something I want to spend a little bit more time on like now because I've been saying that it's not really such a productive time in my opinion to be doing all this work. So, yeah, like, read some books, work on yourself, meditate, learn a new skill. Like, I don't know. Um, when I moved to Austin, I took 2 years of improv comedy classes. Like, I don't know, I never did that before. It was kind of cool. Um, I'm interested in trying new things. So hopefully I'll be able to remember to do some more of that.
Do you think you'll manage outside capital at some point?
Well, I'm managing money for my extended family. So it's a family office technically, like a registered investor, sort of like semi-registered investment advisor. But no, I don't really have interest in managing money outside of my family. I think it would get me too far along towards having a job in the sense that I'm reporting to people. Like it's one thing to go to a family gathering a couple times a year and, while I'm chatting with people, they ask me like about what's going on in the portfolio and I send them like an annual update. And it's very different, I think, than it would be to have outside investors who expect you to be like hitting a certain level of like rigorous updating and like show me how your process is working or not working. I mean, if my family is not happy with the investment returns that I'm giving them, then they could just go manage their own money, whatever. But if I had outside investors and I treated them like that, they'd probably just think I'm a jerk, to put it politely. So I'd rather not have to go down that route and for them to all think that I'm a jerk because I don't really want to spend my time talking to them.
Well, it's funny because I basically did the I think you're at year 6-ish of being a full-time investor. And it
Yeah,
wasn't until I was at year 8 when I started to think about bringing in some outside capital. And I always had it in my mind for 20 years that I was never going to do it, mainly stretching back to when I was a teenager working at an Edward Jones office as a receptionist, going through the dot-com bubble crashing and having to deal with emotions of people I didn't know. It just horrified me. And so I always said no for 15, however many years that was. And then, finally got to the point, and I don't know if it was about hitting my mid 30s or having a family or whatever it was. It was just like you start to meet people that do have the volatility tolerance, that aren't going to bug you, that aren't a-holes, that they understand the way you are because they've been following you, the way you communicate for years, whether it's on your Substack or Twitter or X or whatever.
hmm
Um, and you're like, okay, well, and the ironic thing with me is I didn't take my parents' money when I did it because I didn't want to talk to them about investing at all at Thanksgiving. I didn't want them to
Yes.
ask me anything. So I actually did the opposite of that, where I took no, they all wanted to, and I said, no, I don't want to take, I'm not managing it
Yeah.
because I don't want this to be any type of conversation point at any point, either mentally inside your head or vocalizing it to me. Like, I don't want that.
Yes.
And so it was, so I would just say, maybe think about it that way, kind of invert it. You'll meet some people and you'll meet good people. Um, and I know for me, I feel like it upped my game because after 8 years of just doing this in the corner of my basement, it was great and gratifying. I could continue to do it, but you're like, I think I can do this on a bigger level. And I think it depending on the flavor of investing you're in, which mine might be a little bit more investing and trying to make an impact on the companies at a management level, not in an activist way, but just helping,
Right.
being able to go in with a few extra dollars kind of helps
Right.
that. And it's fulfilling as a person,
Yeah.
the older you get. So it's like,
Yeah.
um, so it, so I would just say you're highly talented. And so
Yeah.
don't close that door entirely. Yeah.
There are a few there, so I should say there are a few other considerations. Because I did think about this quite a lot. One other thing that really mattered to me when I was thinking about this is because I think my strategy, all microcap strategies, but I especially probably do a little bit smaller stuff sometimes. like more like nano cap stuff sometimes, it tends to be very size constrained. So I think selfishly, like for my family's sake, I thought there's always going to be a trade-off between returns and size. Like the bigger you get, the harder it is to generate good returns. And I was thinking about this, like, I don't really want to make all this money for people outside my family if it's going to mean that I can't make all that money for my family. Like, I mean, I made my parents a ton of money. Like I started managing their money because I saw that they were going to just send it to like their Fidelity rep to go put it into like a, I don't know, like a bond ladder or something horrific. I don't know. And um I just told them, you know what? It's going to stress me out to manage family money sometimes because if things aren't going well, it's going to stress me out. But it's going to stress me out more if I've done really well for myself and I haven't done well for my family. So that was that was kind of the missing piece of the analysis that led me to do what I do. And I think I'm at the point now between my own capital and the rest of my family's capital that I wouldn't want to take any more outside capital just because it would also start really hurting my ability to deliver good returns and, play in this space really well. It was always my goal that if I could just do well enough, I would just naturally get big enough that I wouldn't want to take outside capital anyway. So I'm getting closer to that point now, and I'm pretty happy that it's, going well enough. I'll have to tell my family at some point if I feel like, they don't make the cut anymore and I'll give them their money back. But I don't think that's going to happen.
No, and I appreciate you inverting what I just said. I love the way you think, and honestly, probably the next topic I wanted to talk about actually was just your communication style and your independence and the way you communicate. I think it's really cool. You're not afraid to speak your mind. You're not afraid to give your opinion on somebody's stock recommendation.
I'm an ass. I mean, publicly
Well,
speaking.
I will. I'm gonna reframe it just like how you did with me. But I think you care more than what people think from the outside. I
Yeah.
think that you don't like to see people making dumb decisions. You don't like to see sheep falling off a cliff. And if you can
Yeah.
help step into that gap, um, I think that's probably the core reason you do so. And it's not just to be an asshole.
Yeah, I think I get a lot of distress seeing like the human condition being very, stupid very frequently. And I think I get really stressed when I see individual things being very stupid. And so I tried as sort of as an investment commentator, I have historically pointed a lot of things out that I think are stupid. I don't know if I necessarily care particularly about any individual person not losing money on investment because I don't know everybody out there. I mean, someone's going to make money and someone's going to lose money on every dumb thing that anyone invests in, a trader or whatever. There is some kind of grander scheme of like, efficient prices mean efficient capital allocation. So you can prevent like I don't know. If you manage to truly teach people or convince them that investing should be about, efficient capital allocation, maybe you'd prevent things like billion-dollar GameStop at the market offerings at multiples of book value. Like because I'm not even going to get into crypto, but like, something like that, like GameStop, I mean, there's no really practical and societally beneficial use of, you know, giving them billions of dollars. It's just a transfer of wealth from people who are, selling at an overly generous valuation, or to people who are selling the stock at a high price from the people who are getting suckered into it. And eventually it'll all normalize and, people are going to just make or lose money. It's just like Vegas. But I mean, I don't think that like I think that I don't like to get all of like the negative feedback from people whose opinions I don't really respect when I provide my opinions, which is why I've kind of stopped providing them very frequently these days. it's just exhausting. Like it's really stressful for me to sit and have people who probably don't know how to invest tell me that I'm wrong. And, these people are gonna maybe just, go do something else after they're, upset at me. And I'm probably gonna think about it and it's gonna stress me out. So I don't want to have to think about it so much. I'm sorry for rambling. It's just that
No,
I
it's
do
okay.
get stressed about this. And my girlfriend actually was the one who really pushed me, and I really appreciate her to like try to just make like a private Substack, which I've made just for like a few of my friends to read, because I could either, tell people that these investment ideas are really dumb and eventually watch most of those things blow up. And I don't short. I don't like the idea of shorting, so I'm not going to ever short and make money off of them. But I could either do all of that and get stressed because of all the people, being upset at me about my opinions, or I could just not do it. And maybe I could share with just some friends. And if they kind of percolate that, then maybe it still benefits society in some way.
Yeah, no, I think that makes sense. I know it's kind of how my maturation too. I was a completely different person in the way I communicated 12 years ago, 13 years ago, kind of back when it was Twitter. I was very abrasive, very in your face. So I was always on the long side, but I just laugh at some of the things I used to say. And then after a while, you gain enough internal self-confidence where you realize you don't need to show yourself that way anymore. It's like it doesn't really matter.
Still
And
stresses me out though. Like
yeah, and
it
it's
still
it's
just
stressful.
stresses me out to see it all happening. So
Yeah,
it's tough.
yeah. Um, you're really good, I believe, at ferreting out kind of to this point, ferreting out bad businesses and also kind of bad management teams. I think you're pretty good at that. Um, can you talk a little bit about like the first steps of your DD process and situations that are kind of a quick no versus a slow no?
Yeah. Well, I don't know if it's going to be super original. I want to look first at all the historical financials of a business to just see like, because the first, evidence that you can see a business is good or bad is, has it been performing well or poorly? And then you'll try to spend a little bit more time to understand the reasons why it might have been performing well or poorly. And, what I spend a lot of time on, which you're probably referring to, is like trying to understand the competitive advantages of a business. I mean, that's one of the problems is that like it takes time to learn how to understand competitive advantages. And a lot of things that people might think are competitive advantages, like the fact that a CEO has a lot of experience, for example, like that's not a competitive advantage of a business. There are things that most people or most new investors don't really know to look for, like really looking at all the competitors. I mean, I think there's kind of a just a tendency to accept that you can pitch a stock and not talk about the competitors. Um, I think if you read most of my pitches, you'll see that like I don't generally do that. I generally talk quite a bit about competitors because understanding the competition is critical as a part of understanding the company's mode because you'll see why a competitor is competing well or poorly against your company that you're analyzing. Um, when you see somebody pitch a stock that doesn't talk about the competitors, it's generally a sign that like they just don't understand what's going on. So you want to avoid that. You want to know what's going on in an industry.
Mm-hmm. That's a great nugget of wisdom there for everybody listening. Um, let's take some. I guess we do have some questions that came in. Ignoring them, let me see. You might be able to pull them up too, Harris, on your end.
Oh,
I think we already hit the first one, but
okay, I see. Do you want me to go through? Can you see them as well? Or do you want me to go through them?
yeah, I mean, we already did the first one, so maybe like the second one. I
Oh,
think it's a good question. Did your returns kind of
my
diminish
term diminish.
over the years?
Well, the last few years weren't so great. I'd say it wasn't necessarily like a straight progression of the returns diminishing. I mean, no, this year has been good. My best years were 2020 and 2021, like probably everybody listening to the call, except me. I guess, this year has been quite good. Uh, but yeah, I mean, being bigger does hurt your returns. with much more capital allocate. Yeah, I don't think that like you can just keep doing the exact same things as you get bigger. Because naturally, there are some things that I invested in when I first started when I could put like $50,000 into a stock, and if that thing tripled or quadrupled or whatever, that could like really make my year. And I can't do that anymore. So it's always going to just be regardless of the short-term variability year by year, it's always going to go down over time if you're growing. Um, how
Let
do
me
I
read
view
them.
investing in companies with negative earnings? Okay, yeah, sorry.
Yeah, let me read them so if people are listening to this on the podcast, they know what we're talking about. I'm going to skip to on an interview you did with Bobby Kraft, you talked about differentiated data sets. Could you riff on that a bit? I assume it relates
Hmm,
to you put it a lot of energy into figuring the bus out. What does that mean?
the business, yeah.
Business, yeah.
Yeah, I love figuring out alternative data sets. I think the examples that I talked about on that podcast with Bobby was like when I did collector's universe analysis, I kind of figured out like how many cards the company was grading on a daily basis by analyzing the data that was available through their website, just in like an unstructured way. So I was able to actually make my own data set, and that's always cool. I mean, like I don't, when I so with like my biggest position now at Seneca, like one thing I found was that there's like this data via like the USDA, Department of Agriculture, and Seneca makes canned vegetables primarily. So like the USDA buys food for like food banks and school lunch programs and some other government affiliated things, and they like put out competitive tenders for companies to sell food. And so like you can actually see all the bids that different companies make. And like when I found this, I thought this is incredible because I can like track prices. It's not quite like, I should caution people that, there are a lot of like annual contracts in this industry. So just because some portion of this market, like it's a small portion, is being like competitively bid on a spot market basis like this, it doesn't mean that you can just extrapolate this for the whole business. But you can see like changes in industry spot pricing, and you can also just see like who are the competitors and how are they bidding. And it was really cool because like when I found this data set, nobody had ever mentioned it before. And I was like, wow, this is really useful. I should probably keep an eye on this. Um, so when you do a lot of analysis of a business and you really do get deep into the weeds, not always, but very often you will find stuff like this. And it's really cool when you finally find it because you're like, wow, like this is the thing that will really help me to keep a finger on the pulse of this market. Um, so
Do you
yeah, it
do
helps.
you invest internationally too? You know,
Yeah.
do you still t tend to find yourself gravitating more towards the US though, even though you do look outside the US?
Yeah, I mean, I like investing in places that speak English. I mean, it's just I'm not good with languages. Like I've put plenty of things through translators. Google Translate obviously is like a critical tool when I'm doing stuff outside the US. Um, but I'm just never going to know a business well enough to make it like a huge position if it's not an English speaking jurisdiction. It also obviously helps to just know the local environment better. I mean, you know, US is better than Australia. You know, Canada's acceptable. We all know Canada's practically the 51st state. But yeah, outside of the US and Canada, I generally get more wary just to understand what's going on.
What are what are some resources or books that you'd recommend for someone that wants to learn accounting concepts?
God. Okay, well, I think my first and only like really obvious pick would be Financial Shenanigans, which is a great book with a focus on fraud, like finding things that are, being misused in accounting to cover up fraud. Um, it's weird because like I mostly taught myself accounting just by reading like a million 10Ks. Like you just like read enough financial statements and actually care enough to learn how it all fits together. And then you just kind of know how the machine works. It's like instead of reading a book on how a watch works, I'm talking like a mechanical watch, you actually just like start like taking apart watches and seeing if you can put them back together. And if you do that enough times, you'll know how to fix a watch. Or you'll know how a watch works. So it's a bunch of things. Like if you need to know answers to specific questions, then you can look them up online. You can probably find sources. But like it gets back to the idea that investing is like a lot of investing is a game of reps. Like you got to put in the reps. Like if you do not know how to read a 10K like the back of your hand, if reading a 10K is more complicated than like reading a Dr. Seuss book, you got to read more 10Ks.
I think that's a great place to leave it. Harris, I appreciate you spending over an hour with us. This is a great, robust conversation across a variety of topics. And thanks for coming on and doing this with us.
Yeah, thanks for having me. So hopefully
Awesome.
yeah, stay in
Where
touch.
do people find you? You're on X, anywhere else?
Oh, yeah, I'm on X, and I'm on MicroCapClub, and I'm in Austin, Texas.
There you go. Look them up. All right. Thanks,
Yeah,
Harris. Take
thank
care.
you, Ian. All right, take it easy.